Welcome to the CLS Monthly Market Review. I'm Rusty Vandeman, Chief Investment Officer at CLS Investments, and with me this month is Grant Engelbart, Portfolio Manager at CLS.
Hey,
Welcome,
Rusty.
Grant. Well, we're going to talk about the markets and kind of our outlook. And so first of all, the markets last month, it's going to be the best month since January. Stocks are up, bonds are up, commodities are up. International markets were not up. Europe was down, and also kind of the big performer were large cap growth stocks. So let's talk about those areas. First of all, let's talk about Europe.
Sure.
What's going on there?
A couple things going on in Europe. More recently, there's been worries after the Italian election. They're struggling to form a government. So there's worries that there'll be another vote later this year that could potentially include a referendum to take them out of the European Union. It's not sure. We don't know yet. Markets don't like that uncertainty, so it's rattled the markets a little bit. But they have since stabilized, and we've seen that, and it's been fairly controlled and concentrated on Europe and some in Italian banks and
Right.
things like that. But what's also happening in Europe, we've seen economic activity actually start to kind of roll over a little bit, slow down a bit. We've seen really strong, robust global growth that it just can't continue for a variety of reasons, and that's starting to slow a little bit in Europe. Inflation is actually picking up there, but other activity sentiment gauges are slowing a little bit.
So you bring this all together, how's this changed our thinking?
Yeah, that's a good point. And Europe's still fairly attractive from a valuation standpoint. Like
Yeah.
we don't dislike European equities from that standpoint, especially relative to the United States. But at the same time, there's other areas in the developed and emerging markets that are more attractive to us to deploy capital.
Right.
So even the UK, which is outside of the Eurozone or going to be outside of the European Monetary Union, has very attractive valuations. Areas in Asia, Canada even. So we're looking at those markets a little bit more in detail and kind of avoiding what's happening in Europe, at the margin at this point.
So in sum, Europe's become actually, believe it or not, a little more attractive. It's just that we like other areas in the international space even more.
Sure.
All right, let's talk about an area we don't like as much, and regretfully it's an area that's doing pretty well this year, is large cap growth stocks, including some of the big names. It seems like it's kind of bringing up parallels to a couple other eras in kind of stock market history, and I'll let you take the first one.
Sure. It reminds me a bit, I guess, of the dot-com era and the tech bubble. Some of the big names, the FANG names, have the returns are pretty astounding. There are some differences. Those companies are a lot stronger financially than they were before. Valuations aren't yet to that level. They're close to that level, but they're not yet to the ultimate highs that we saw back then.
Yeah.
But on the kind of the flip side of that is you're starting to see expectations rise a lot for these companies, done so well, and the expectation is for them to continue to do well. And we saw in the most recent earnings quarter that reports, even if they beat by a smaller margin than expected, companies were not being, or were starting to be penalized for that, and we saw stocks trade off a little bit on some of those reports that just weren't as good. So at a certain point, there's going to be a penalty, I guess, on those companies for having such high and lofty valuations and expectations.
Good point. I mean, the valuations are so high, expected returns moving forward just have to be depressed. What happened after .com, though, which is really important to particularly our investors, is that globally diversified portfolios actually held up pretty well after the .com era. So actually there's another era, of course, the Nifty 50 back in the 70s, a little before your time. And basically it's probably a better parallel to now in some respects, that those were high-quality companies. All those companies virtually are still around. And they also got to extremely high valuations. And again, just to show how much valuations matter, is that when they broke down, a lot of those names had negative returns over the next 10 years. And so valuations matter, and some of these names that have really taken off, I mean, Amazon has a valuation, a PE, price earnings ratio of nearly 300. So anyway, it's just important to stay globally diversified.
Right, and I think that's important. Is there's plenty of other opportunities in places around the world. One thing we've seen is that the gap between both performance and valuations between value stocks and growth stocks that we're talking about here has gotten very, very wide. And the widest since the tech bubble. And if you exclude the tech bubble, it may be the widest in decades or longer.
Depends how you cut the statistics.
Exactly.
I mean, some say it's the widest gap ever. So you could call this one of these fat pitches that only happen a few times in an investing career.
Absolutely.
So that's the reason why we like value stocks
Exactly.
too. Great. Well, thanks, Grant.
Thank you.
And thank you for your time and trust in CLS Investments.